Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. I am joined today by Dr. Richard Smith, one of my favorite thinkers who is on a mission to democratize the sometimes complicated and esoteric world of investing and make smart investing strategies in the financial markets available to everyone. Dr. Richard, welcome.
Great to be here, Dan. Thanks for having me. I love the name of your podcast, Standard Deviations.
You know what's
That's funny? At the heart of it.
Yeah. Well, it's funny because I've never explained that, I guess, because I think my listeners are smart enough to figure it out. But there's the obvious finance. Implication of it. But I love the idea of being standard deviations in our personal and psychological lives too. We're all a little weird, and that's pretty standard for us to be a little bit deviant and a little bit strange. But I'm thrilled to have you here. We've communicated over the years, and I've learned a ton from you. So I'm thankful that you'll get to now share that with my listeners. You have a PhD in systems science, and you spent 13 years working for Pfizer, who's, of course, been very much in the news lately. First of all, what the heck is systems science? And how did you find your way to our little part of the world here in finance?
Well, it's not so little anymore, this world of finance, but we'll get back to that later. So systems science is a little niche, a little corner of academia that attempts to be more interdisciplinary and more holistic. When you think of systems, the first thing most people think of is the idea that the whole is greater than the sum of the parts, right? Or at least that's what I think of. And, that has always really intrigued me. And I'm sure you'll connect with it, Dan, because of your, background in psychology, right? So, there's this vein of this direction, I guess, in modern life and certainly in academia of reduction and quantification. And system science, attempts to swim upstream a little bit, let's just say. So, and you have these systems thinkers in the modern world. You have Peter Senge, right? The fifth discipline guy. And there's been other systems thinkers. So for me, systems science was a way to kind of blend psychology, computing, and mathematics into my own kind of creative PhD dissertation. So my dissertation was actually essentially on information theory, and how can scientists and researchers be more honest about the uncertainty in their models and in their forecasts, and not let unwarranted assumptions propagate throughout the models and lead to something that in the end doesn't really do service to what you're trying to do. So that's always been a big concern to me. And the whole relationship between models and the real world is also, that is in many ways the thing that's most interesting to me. We build these models, then we apply them to the real world, and there's some gaps there. So that give you some idea?
It does. I want to talk about uncertainty in just a moment, but I want to talk about the systems piece for a second, if you would. What year did you graduate with your PhD?
2000.
So in the intervening 21 years, what would you say has been the trajectory of systems thinking in the world? Are we moving towards a more interconnected systemic way of thinking, or are we still thinking in sort of ones and twos? Because when I think about my own discipline of psychology, I think that's one of the big weaknesses in my education as it stood when I walked across the stage.
Yeah.
Or actually didn't. I never walked for any of my degrees, but metaphorically, when I would have walked across the stage.
Yeah.
It was like an individualist sort of an N of one, and they were self-encapsulated. And one of the things that I've liked about my exposure to markets and behavioral finance is that I've had to become more systemic in my thinking. So how are we doing as a world over the last 20, 21 years?
I think that we're bifurcating. So, the world is increasingly expressed not as ones and twos, but as zeros and ones. And, I was just reading an article by Nassim Nicholas Taleb and Benoit Mandelbrot, and talking about how, like, in economics, people would rather have a number than no number, even if the number is wrong. So there's this, deep dependence in our systems today and in our economies on number and quantification. And it seems somehow like less uncertain if you have a number that you can put on it, right? It gives you this false sense of security. We need numbers, but I think we make a big mistake when we start to see the numbers as something solid and real, when really they're just models. So on the one hand, I see us rushing down this path of technology and number and digits and everything being, kind of like a big computer simulation. On the other hand, I think that there are some significant currents of resistance and of people saying, hey, it's not all number. We need to think about the people too. So I was listening to a podcast of Tim Ferriss interviewing Jim Collins, right? The Good to Great author and management guru. And Jim Collins's mentor was Peter Drucker. Tim Ferriss loves Peter Drucker. He wanted to know what it was like to work with Peter Drucker from Jim. And Jim gave some very nice descriptions and accolades to his mentor. And then he said, I think the question that drove Peter Drucker through his whole life was, how do we help create a society that's more productive and more humane? And so I think that, we've kind of got the productivity side down pretty good. Things are going faster and faster. But I think people are, asking real legitimate questions right now. In finance, certainly, that's part of this kind of GameStop and meme stock, Robinhood, Citadel conversation, but also more broadly about technology and the role that it plays in our world. And how do we, maintain our humanity in the midst of these technological advances in what is hopefully productivity, although even that's not always crystal clear.
It seems to me that productivity and humanity are more interconnected than I think we sometimes give credence to. I saw some research out of Japan recently that said that they'd been experimenting in pockets with a 4-day work week, and that productivity was up some ridiculous, like 35 or 40% when people had longer weekends. And it's like, why are we so allergic to this idea? Like, why do we conceptualize productivity and humanity as ends of a spectrum and sort of instead of being as tightly knit as I think we agree that they are?
I think that's I think that is spot on, Dan. And, that does give me hope that systems thinking is having a positive impact on the world. I do see some inspiring things going on. And that's a great example. On the other hand, there's a sort of risk, in part this, I got my PhD in system science, Dan, but I did not go into academia afterwards. And that was because there is this current amongst systems thinkers. I don't know if you ever studied or read any of Ken Wilber's work, for example, but he's a good example of it, where somehow, you're going to be the smart guys in the room that solve everybody else's problems for them, and I don't think that top-down approach is really the best way to build societies. So I'm a big believer in bottom-up and not just top down. And that's part of how I got into investing in finance in the first place was, I was inspired to help the ordinary person do better in the markets. And I was, disappointed in the resources that I saw out there to for us to participate in the markets in a systematically successful way.
Yeah. So I want to, it's been a few years, but I want to have you kind of cast your mind back on your dissertation research. And I mean, you've done plenty of work on this since, but
Yeah.
you have a top 5 cool finance nickname. Now, I think the coolest finance nickname is Dr. Doom. I was very, very bummed out that one was taken, that I couldn't be Dr. Doom. You, though, Doctor of Uncertainty, which is very cool. It invokes sort of like you petting a cat in a volcano somewhere. I really like the image of you as the evil Doctor of Uncertainty. But let's talk about uncertainty. Coming out of 2020 and into 2021. I mean, unprecedented and uncertain were kind of the words of the year last year and into this year. Talk about where we are today with uncertainty and how it's impacting the market behavior we're seeing today.
Well, I do think it was an incredible year for uncertainty and an incredible year to, if you ever had any doubts, to put to rest the idea that somehow you could predict what was going to happen in the midst of, because of all this uncertainty, right? I don't know about you, Dan. I don't remember going through anything like this in my lifetime as what we've been through in the past year.
No.
And the economic disruption of that, the death that's happened around the world, and for the stock market to, essentially soar and be at all-time highs after a very violent but brief sell-off. I mean, talk about a disconnect between what our sort of, life on the street might lead us to believe versus, how markets sometimes behave. Don't you think?
No, absolutely. I was for curiosity's sake, I pulled out the January 2020 big bank S&P price targets recently. And what's incredible is of course, everyone's always bullish, right, in these things. But every single one of the big sort of white shoe Wall Street firms undershot the actual performance of the S&P in January of 2020. And what's incredible to think is that's before they knew there was a pandemic coming. I mean, if you had told them that there was a pandemic coming, how much more muted would their predictions have been? And yet all of them undershot the actual performance. So it's weird for me to think that the market is, in my estimation, likely much higher today than it would have been otherwise. In a timeline where we don't have all this death and destruction, I think the market is actually much lower than it is today, which is really, really strange to consider that in some respect, the market is so elevated today because things are so bad and not in spite of it. I don't know.
Yeah, agree. And to me, it's really the icing on the cake of this lesson that anybody involved in finance has to eventually come to terms with, that you really can't predict the future. And you have to figure out another way of participating in these fundamentally uncertain, unpredictable environments that lets you stay in the game, but still be able to sleep at night. And to me, that's the whole rub of being in the markets is, how do we participate, but in a way that, we can still sleep at night. So if I could share a quick story that I think will resonate with you. When I first started out getting interested in the markets, this was the late 90s also, while I was in graduate school. And me, along with everybody else, was getting allured in with the markets and the dot-com boom and bust. Kind of feels familiar to the time that we're in right now. I was a, young 30-something at the time, and I got interested in the markets. So I met a guy who has written like 50 books. His name is Jake Bernstein. He's known in the futures business and the commodities business. Great guy. And I said to him one day, Jake, what's the difference between the winners and the losers? And he said, the winners don't need the money. And like every year that goes by, Dan, that makes more and more sense to me. It's really in a way become like my philosophy of investing. How do I be in the markets in a way that I'm not going to be put under pressure if the markets start to go nuts, right? Mm-hmm. So how can I be in the markets and not need the money, not make reactionary decisions because my expectations of what's going to happen in the markets are out of whack, right? So I think we get into trouble when our expected values about market behavior are, distorted from the reality of market behavior. And the only reality we have is historical market behavior. So I hope I'm not getting too abstract and abstruse here, but I suspect that you're following me. But let me check in with you.
No, I think I'm following, but I want to, you're on this mission to help, the every man and the every woman become a better investor. And I think, those folks, when you look at the average person in the US and what their financial life looks like, I mean, they need the money. So how can we practically situate ourselves so that we don't need the money? Is it as simple as having a safety bucket, if you will, sort of a cash reserve for hard times so you can ride out difficulty? How practically can an average person making an average salary avail themselves of this truth that not needing the money is the way to go?
Well, you have to take a certain amount of your income and set it aside for investing. And you set a certain amount aside for savings too. So you make a bucket of money that you decide how long you're okay with that money being unavailable to you. Mm-hmm. It may be 1 year, it may be 5 years, it may be 10 years, it may be 50 years, right? So once you have an answer to that question of how much money do I have that I can be okay with not getting back for X period of time. So I think for most people, I try to get people to think at least in terms of a 1 year to 5 year horizon. In our soundbite world, that's pretty hard to do. Our soundbite gamified world, I might add. But you have to understand how much money you can not see for a little while and how much pain you're willing to take with that money. And once you've answered those questions, then you're in a much better position to look at historical market behavior and see what kinds of investments are going to work for you. So you must have come across this basic principle, Dan, in your work with investment advisors.
Sure. We're designing something at Orion right now, a technology, trying to think what I can say about it, but it's a goals-based technology that basically is intentional about the way that you mentally account for your money, because we know that the ways in which we mentally account for money impact our ability to save, spend, invest that money. So we're getting very concrete with this thing you're talking about like, this is the safety bucket. This is sort of your income bucket, and this is your aspirational bucket. Plenty of folks do that, but it's a simple but powerful mechanism to help for you, to label that money with respect to what it's good for and how it's likely to behave. Because heaven knows that, your 50-year bucket's going to be, it's going to be volatile, right? I mean, that's just how it goes. But if you go into it expecting that, you can better handle the ride. So
let's take a specific case study right now, which is one that's on a lot of ordinary investors' minds, which is it too late to buy Bitcoin? Right? So a lot of people are interested in Bitcoin right now. You know, the mentions on social media are through the roof. People who, 5 years ago when I was getting interested in Bitcoin were like, that's absurd, are now calling me up going, Richard, should I get into Bitcoin? So if you're going to be in Bitcoin, you need to be okay with Bitcoin falling 80 or 90%, or even going to zero, right? If Bitcoin gets hacked, it's all over. And it hasn't happened yet, but it's not completely out of the question, especially with things on the horizon like quantum computing. So you need to be okay with whatever money you put into Bitcoin essentially never coming back to you. So, and you need to be okay with holding that money, for at least 3 years before you can reasonably hope for it to recover if it does fall 75, 80%. So 2017 to 2018, December 2017 to December 2018, it fell 83%. And it took, another 3 years for it to recover. So that's the kind of thing that can happen with Bitcoin. So I tell most people, hey, if that's too much for you, but you still want to be a little bit in Bitcoin, put $10 a month, through Coinbase on autopilot, and just start to accumulate a little bit and see how it feels and learn what the market's like and see how you interact with being invested in Bitcoin. And then over time, you can make more informed decisions about what role you'd like for that to play in your portfolio.
Yeah, it's a great practical example, because you can read all the books, right? You can read all the books you'd like about these things, but there's nothing that gives you the punch in the gut experience of watching an asset drop 80% like living it, right? Yeah. Conversely, the euphoria of watching it rise, whatever, astronomical percentage it's risen in the past few years. So there really is no substitute, I think, for living through it. But like you said,
I just was writing about this morning. So let me just give you a couple numbers, okay?
Yeah.
$10,000 invested in Bitcoin 5 years ago, you'd be a millionaire today. Okay. So Bitcoin was at $440 a Bitcoin in February of 2016. It was at $50,000 a Bitcoin in February of 2021. Okay. So $10,000 in February of 2016 is worth $1 million today. Meanwhile, at the peak in December of 2017, your $10,000 was worth $443,000. Okay. How many people can, not sell from $10,000 to $443,000?
Right.
That's bad enough. But then your $443,000 went down to $74,000 over the next 1 year. 80 plus %. Think about stomaching that, right? That's tough. So to get to $1 million today, in 2021, you had to ride up from 10,000 to 440, back down to 73, and then wait 3 years to get back up to an all-time high of $1 million. So that's the kind of wild ride that you got to be able to put up with if you're going to get rich from Bitcoin.
Yeah, that's why I hate these clickbaity articles about, if you had bought Apple at whatever, if you had bought who can stomach it, right? Who can stomach it? Not many of us.
No.
Yeah. So keeping on this topic of uncertainty, one thing I've observed over the last year is that people tend to have two sort of predictable reactions to uncertainty. And in some respects, I think there's a common thread that runs through them, but they sort of, at first blush, sit on opposite ends of a spectrum. One thing that people do is they get catastrophic in their thinking, right? They just sort of assume the worst. They imagine the worst case scenario and they kind of prepare for that. So I think the thought is that if I'm prepared for the worst, nothing can hurt me. I think the other thing that people do is they paper over uncertainty entirely and just sort of assume that they know exactly what's going to happen, and it may be even very positive, right? So I think, there's been this kind of mantra in the market, stocks only go up, has become itself a meme, which is of course not true. So where do you see the mind of the investor today, and how can uncertainty lead us, this common thread of uncertainty lead us everywhere from doom and gloom to massive euphoria?
Well, this is one of the reasons that I do love the nickname of Doctor of Uncertainty, because you may see it as, in a volcano with your cat, right? But I see it as almost like a psychologist or a medical doctor helping people to be okay with uncertainty. Because, what I see is that people are constantly clamoring for certainty, even if it's false certainty, right? That was the quote from Mandelbrot and Taleb about economists, clinging to number, even if the number's wrong, because a number seems better than no number. So to me, maturing as an investor is learning to embrace uncertainty and not seek out comfort in false certainties. And so that's what I see, so many people doing, especially when you get into these, crowd type of emotions that are running, pretty high today. You need to be able to embrace uncertainty. You need to be able to work with uncertainty, and you need to be okay with it. And really, the more you're okay with it, the more you understand it's really about managing risk. That's your edge in the markets. To me, Dan, the markets wouldn't exist if it wasn't for risk, okay? Companies come to capital markets to mitigate risk. If they didn't have any risk, they wouldn't need to come to the markets, right? They just know what was going to happen and they would do it. But they come to the markets because of risk. So those of us who are loaning our capital to the markets are what the markets are paying for, what companies are paying us for, is to help mitigate their risk. So risk is at the center of why markets exist. And managing risk is what people who put their capital into markets, not because they put their capital into the markets to grow it. You grow it by managing risk, not by predicting the future.
So I want to talk about your book about risk and your ideas about risk, but I'm still kind of hung up on two things you said in that last piece. I'm 100% on board with you that we don't need to sort of embrace false certainty, and that's something we need to learn to do. I've also written entire books on why we are so prone to embrace false certainty. So how practically speaking can we begin to materialize this in our lives? How practically speaking can we begin to embrace uncertainty when we're really not wired to do it very easily?
For me, one of the big entry points has been using volatility. That's why I like the name of your podcast, Standard Deviations. So I think there's a book, I don't know if you've ever read it. It's called Trading Risk by Kenneth Grant.
I haven't.
And great book. And I talked to Ken about a year ago, and he called it volatility budgeting. And so, look, volatility is not the same thing as risk. I get it. But for the average person to begin to understand, relative risk levels in the market, volatility is a good starting proxy for risk. So, my approach has been basically to quantify volatility using standard deviation, right? So, over the course of 1 year, one standard deviation of price changes in Tesla is something like, say, 30%. So 65% of the time, you can expect Tesla to be up or down 30% over the course of 1 year. And, versus a stock like Walmart, it might be something like 12 to 15%. So I found that to be a really useful starting point for people to start to have a better idea of uncertainty and the reality of uncertainty in the markets, and to start to work with it instead of running away from it.
I like that risk budgeting, volatility budgeting. So the second question that emerged from that conversation was, we know that economists and other market professionals, we know that they put a number on things sort of, in many cases, sort of blindly, because that's what the public is clamoring for. I mean, we're all sort of clamoring for this pseudo certainty. So we know in some respects that a lot of this stuff is just made up from whole cloth. I mean, even though it has perhaps elegant trappings or mathematical trappings, but what we also know is there's a sort of truth to it, because the reflexivity gets involved, and it's like it's true because someone said it's true, and so a number that may have
until it isn't
right until it isn't. So a number that may have really kind of come out of nowhere, candidly, may suddenly take on an element of importance for a time. And I've seen so many people over the last really about 12, 13 years just shaking their fists at the sky and pounding the table about stuff that they perceive as not fair or not true or not right about markets. And
they mostly value investors.
Yes, and they're just wrong. Like the people who hate the Fed, people who hate whatever, and it's like, at what point do we run with the herd for a moment, even if we disagree in some respects?
Yeah. It's interesting being human, isn't it? So, there's not really easy answers to this question. I think that sentiment is absolutely something that people have to incorporate into their analysis if they're going to do any kind of timing of markets, right? If you're just going to be, hey, a buy and hold Warren Buffett type investor, choose 10 companies, and you got 30, 40 years, man, that's great. But, for most of us, we don't have that luxury. And so, I think right now is a great illustrative example of exactly what you're talking about. A lot of people are still long the markets, but everybody's got one eye on the exits. And are very concerned, like, when is the music going to stop? And so, what can I say? I'm still long myself. I'm paying close attention to sentiment. I'm paying close attention to cycles. And I'm also just checking in with myself about, how much risk can I put up with, given where I'm at in life and where my businesses are at and what money I'm going to need when. So just want to make sure that I don't get caught flat-footed and I don't get myself in a position that, I will keep me from sleeping at night.
Well, you just mentioned cycles. You're the CEO of a nonprofit called the Foundation for the Study of Cycles. You're the systems PhD. Talk to us about the importance of understanding and mastering cycles as a path to becoming a great investor.
Yes. Well, I got interested in cycles probably 10, 12 years ago, and for me, it's connected to the doctor of uncertainty part, right? So once you sort of stop playing the game of that you can predict markets and that what's going to happen, you really are freed up from a lot of unnecessary mental work, and you're more interested in broad patterns instead of what your particular ideas are. So cycles sort of had a natural appeal to me as a mathematician. Cycles are mathematical. They use Fourier transforms, digital signal processing. And they make these pretty sine waves, and then you can add them together and they can match your price curves. But I think that cycles also are connected to our humanity. I think they're manifestations of our collective cyclical nature and our collective cyclical moods. And so they've been very useful to me in terms of incorporating a little bit of timing into my overall investment strategy. So, right now, for example, for a while now, I've been looking for a cycle top somewhere around April or May of this year. And so I'm keeping track of that. And I still think that's a good possibility that the April-May 2021 timeframe, could see a significant market top. So I do that through cycles analysis. I do it through sentiment analysis, one that you're probably familiar with, the National Association of Active Investment Managers, right? The name index. They were recently, these are the active investment managers. So people who are picking stocks, advisors, and they were, 120% long. And that hasn't happened for a long time. So, the pros are all in, the Robin Hoodies are all in. There are 20-year cycles in the markets. The first couple of years of every second decade are usually down. And we've had a lot of up so far. So I wouldn't be surprised to see some significant down sometime in the summer or fall of this year. So that's a little bit about how I use cycles, why I study cycles. I want to know about them. I see them as kind of like a wind sock at the airport, right? So to me, they tell me which way the wind is blowing. Doesn't mean that your plane can't take off into the wind and do just fine, right? You'll be slowed down a little bit, but when I see cycles coinciding with other extremes, especially in sentiment, that's when I start to give them a little more weight in my overall analysis.
Yeah, I was going to ask how the truth of cycles coexists with the truth of uncertainty, but it sounds like you explained it there with the windsock analogy, right? Like nothing's for certain, right? But it just gives you a heuristic, a lens through which to view the market and make some assumptions. I like that.
Yeah, and you have to approach cycles with a respect for uncertainty, because every once in a while, a cycle forecast will nail the top to the day, and people start to get totally bonkers about the magic of cycles. And as though there's some mystery here that, you got the Holy Grail now. And that is a disaster if you ever get into that mindset. So cycles don't always work. Cycle bottoms tend to work better than cycle tops. Cycles that, have been working for months or years can all of a sudden stop working. So, it's a delicate balance. And I think the windsock analogy or metaphor is still the best one that makes sense to me.
Yeah. Now you were going down a path about risk earlier, and I was really intrigued in some of your thoughts there. You're actually writing a book called The Risk Manifesto, and I am a sucker for a good manifesto. It's not done yet, but can you give us sort of a sneak peek into what the book might look like and your philosophy of risk?
Yeah, well, look, to some degree, you have to understand who you're talking to, right? to a carpenter, or every hammer looks like sees everything as a nail. So, but I don't know how I'm interested in what you think about this, Dan. I see the world increasingly becoming more and more like the financial markets. So what do I mean by that? The financial markets went electronic and digital, 20, 30 years ago now? The financial markets involve a lot of numbers. The financial markets involve a lot of participants kind of playing poker with each other. They involve a lot of probability and statistics. They involve a lot of arbitrage. They involve a lot of computing power. Well, that sounds also to me a lot like Google and Facebook these days, right? So, I see our world as being increasingly built on probability and statistics and, really fast computers and lots of data. And so what I've learned in the financial markets, and certainly, like in academia, I got the theory of risk, but in investing and trading, I got the reality of risk, So, but I just see our world going in an increasingly financial direction, and that more and more, a lot of decisions that face people are similar to investment decision making. So we know that risk management is table stakes for professional investors. And it's basically, completely not considered by the public at large, right? And so how do we start to really evangelize simple principles of risk management, like volatility budgeting, like a standard deviation, to the public, and help them to see that, not only will this help you grow your wealth more effectively, but increasingly you can use this to do things like decide, which rabbit holes are you going to go down on social media, right? Because there's a kind of, meme war going on in social media of trying to get our attention with these different narratives. Just like, in the stock market, there's, efforts going on to try to get our attention on different financial scenarios. So that to me is a really interesting topic. And so, not only do I think young people today really have an opportunity to be smart about their participation in the markets, and I think they're capable of it. Actually, I'm more optimistic than others are about the intelligence of young people out there. They're digitally native. They have a sense of this world that a lot of, boomers and Gen Xers didn't grow up with. And I think that technology has really advanced in, we carry these phones around with us all the time. There's a lot of behavior design that's understood today that wasn't understood before, behavioral psychology, right? And I think all that can be leveraged to help people, start to think about wealth in a little longer time horizon, kind of similar to how 20 years ago, people started to think about health in a little longer time horizon. So that's the idea of the Risk Manifesto. How do we help people to understand that the world is increasingly architected on the mathematics of risk, and that, having a little bit of facility with understanding risk and tracking risk and managing risk is indispensable in today's increasingly digital world.
Do you think, given this financialization of the world that you're talking about, do you think that risk management will make its way into things like, I'm thinking of like a dating app or something? It was like, if you marry this person, here, here's your probability of success with this person, or I don't know. It seems like there's a million other big decisions that could be risk managed.
Absolutely. I think that is a incredible opportunity to incorporate, simple principles of risk management into our digital decision making. Now, that might get you to the point that you have a couple of candidates of who you might marry, right? You're not going to make the final decision based strictly on data, but I do think it can, data can help get you in the right neighborhood, and then you bring your other capacities to bear to make the final cut.
I'm glad this technology didn't exist when I asked my wife to marry me, because she, the computer would have told her just how dumb it was. So I'm glad I could get one over.
She didn't have that option at her fingertips.
She didn't know. Now you're working on a technology now, an app called Stock Savvy. Is that what that app aims to do? Is help with the risk management process?
Yes, I really have been inspired by a lot of the technology that I've seen in the fitness space, and the health space. Tracking what we eat. Noom, the dieting app, I think has been an inspiration. There's a fitness app called Whoop that I really like that measures heart rate variability, and it took the whole world of kind of exercise and working out and reduced it down to two measures of strain and recovery. And it doesn't care how you exercise, if you run or you row or you swim or you walk or you're an Olympic athlete or you're just getting off the couch for the first time in years. Anyone can kind of measure how much strain you took on in a given day and how much you recovered at night. And so you start to build a relationship with these ideas or with these cycles, really, in your life of strain and recovery. And I think that there are opportunities in people's financial lives to start to track the bigger picture better and kind of see how the parts fit together into a whole. So that's look, Dan, it's a work in progress. This is as they say, a blue ocean idea. And I'd love to talk to you about it sometime, because I'm sure you've thought about similar things yourself here. But to me, it's about how do we start to help people to build a relationship with reward and risk in the markets, and just start to have a relationship with that, start to feel the ebb and flow, and then start to build up your risk tolerance, understand that you can kind of tune the dials between reward and risk, that you do have some control over that you can, anticipate, you can factor in uncertainty and, not try to stick your head in the sand, but actually develop a relationship with it. So that's what inspires me. This is a work in progress. I'm doing a lot of user testing right now, especially with younger people, to figure out, where can I connect with people and where can technology support people on this journey to ultimately, to better wealth.
Great. Thank you so much. Well, hey, Dr. Richard, this has been awesome. If people want to learn more about your ideas, about all the big things you're up to with tech and everything else, where can they find you?
At drrichardsmith.com, drrichardsmith.com. Pretty simple. And thank you, Dr. Dan.
Yeah, no, my pleasure. We don't get to talk as much as I'd like, and the cool thing about having a podcast is I can lure you on here and hear all the cool things you're up to and get caught up in the same time. So thank you again. Everyone go check out the website. Thank you again, Doc, for coming on the show. I know folks have gotten a ton from it. So thank you.
Thank you for having me.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.